Today we are excited to be talking with Eleanor Swanson, Portfolio Manager at Firetrail Investments. Eleanor has over 7 years experience in the finance world and in that time has become an expert in Australian small companies. We're excited to learn about all of that and more today. Eleanor, welcome to You're in Good Company.
Thanks, Maddie. Thanks, Sophie, for having me on the show.
No worries at all. Now, we usually start off by getting to know you a little bit better. So wanting to know, what's the best thing that's happened to you in the past 7 days?
Well, I was just saying to Maddie that I've moved into a new place in Coogee. So I feel like I've timed it beautifully with summer kicking off in Sydney, right next to the beaches, the restaurants. Yeah, it's an upgrade. So feeling pretty good about the move.
And I was just saying that I'm very jealous and I need to work on Soph for a move up to Sydney. Eleanor, if you could have dinner with anyone, who would it be and why?
So I've actually just finished this person's biography, and I am a little bit of a science nerd, so that's kind of where it's coming from. They're also not alive, so I'm assuming that I'm allowed to go on a dinner date with a person that we bring back to life. But yeah, the person would be Marie Curie. So I just read her biography. It's written by her daughter. And, you know, I'm sure you're aware, she's won 2 Nobel Prizes. She had a really tough life. And I just think she'd be fascinating to have dinner with.
When you said you just finished the biography, I thought you meant you finished writing it. And I was like, wow. She really can do it all.
Biographies of scientists.
I was very impressed.
I haven't quite got there.
Do you find that you're a biography reader? Like, is that the type of book that you go to?
Not really, actually. I just find her fascinating. And so I saw it on a bookshelf and had to read it. I'm actually more of a fiction girl. I find, you know, when you're working long hours, you kind of just want something to switch off. So, yeah, it was a little bit out of my usual genre.
Yeah, I'm the same. Every time I go on holiday, I'm like, just give me something that I don't have to concentrate on. Thank you.
Yeah.
And Eleanor, if you could be a stock or company, who would you be and why?
Yeah, so again, this is something I've been looking at recently. We did a bit of work on fund managers in Australia. We wanted to get a bit of beta into our portfolio, and we landed on Pinnacle Investment Management, and they actually own 20% of Firetrail, so I might be a little bit biased, but it's a really awesome company. Basically, what they do is they seed fund managers. So the great thing about Pinnacle is that they're diversified across asset classes. So most fund managers in Australia, you know, they're either an equity manager or, you know, a real asset manager. And so you don't get that diversification. Whereas Pinnacle, they've got real assets, they've got credit, they've got equities, they've even got agriculture. So when the equity market's down, it doesn't necessarily mean they're going to underperform. And it's a really capital light model. So to date, for the fund managers they've invested in, they've got a 10x return on that initial capital outlay. So it's a pretty amazing business model, and I think it's a pretty good company to be in if you kind of have a positive medium-term view on the market, which all of us people that work in markets do have that positive medium-term view. So yeah, if I was a company, I'd love to be Pinnacle.
Nice. Well, Eleanor, you say that you've been working in markets and you have been for a little while now, and I think you've made quite the name for yourself with some pretty incredible stock picks along the way. But I'd love to go back to sort of you when you were starting out investing on your personal journey. What would you say, do you think, was your biggest motivator for sort of learning about investing and sort of wanting to grow your wealth, I guess?
Yeah, I think what really got me into investing was just, I just loved trying to find companies that were going to outperform the rest of the market. And I think it's pretty overwhelming when you're starting out trying to figure out what that is. I heard one of my girlfriends referring to markets as, you know, like reading the star charts, like it just seems so random why stocks move up and down. But at Firetrail, we kind of try and keep it pretty simple. And we've got 3 philosophies that kind of drive how we think about investing. And so one of them is that, you know, every company has a price. So we're very driven by valuation. So We're not going to just jump into, I feel like cryptocurrencies was a massive fad that everybody jumped into. At the moment, it seems like everybody wants to jump into lithium stocks because of decarbonisation and electric vehicles. And we see a lot of companies in that space that look incredibly overvalued to us. So we're always, trying to figure out what we actually think the assets are worth. And over the medium term, you do get much better returns investing based off valuations. So that's one thing we do. Another thing we do is that we try and focus on kind of 2 or 3 key things that are going to drive the share price of a company. If you're looking at a company, there's often huge amounts of news flow. You can get distracted going down a rabbit hole. So we just focus on these 2 or 3 drivers. And I mean, like a good example would be, oMedia, which is an outdoor advertising company. If we think about what matters for oMedia, it's going to be what's the ad market doing, how are they going in terms of recovering their revenue post-COVID, and then do they have a good balance sheet to withstand an economic cycle? And if you get those 3 things right, you're probably going to, make the right decision in terms of investing. So, yeah, we kind of have those kind of few philosophies we think about. The other one is share prices follow earnings. So I'm sure you've seen, if you've been following, quarterly earnings season in the US, the minute a stock downgrades, the share price follows. So we're pretty obsessive with forecasting earnings for companies in our portfolio and making sure that the companies are either going to meet or beat analyst expectations. And if they're not, we probably would seriously consider moving it on because we just know how the share price is going to react. So kind of keeping it simple and kind of following those 3 key philosophies has really helped me, I guess, uncover what drives a company to outperform the market. And it's made investing a lot more interesting, I guess, because it doesn't feel like some sort of random, up, down, volatile, all over the place beast that's overwhelming.
Yeah, it's a great strategy, although I have to say I'm not sure what you mean about stars moving all over the place. I think personally I'm a bit of a believer in star signs, so I think there's a lot of logic to that.
Now, it sounds like you obviously have a very long career in the profession. So I think along the way you would have learnt a lot. For you personally and for someone that's listening at the moment, thinking about the market being volatile, you're saying that, you don't see it as such a volatile thing if you've got your lessons in place. Like, what is one of the biggest lessons that you've learned on your personal journey with investing?
Yeah, I think one of the key kind of takeaways for me is often you come up with an investment thesis and it can look really incredible in a slide deck or, in an Excel model. You put in all the drivers and it looks amazing. But at the end of the day, when you're investing in a company, you're investing in people because you need that management team to go away and execute on that strategy. So you often will hear fund managers, go on and on about, how companies in their portfolio, they've got amazing management teams, they've got an ownership stake in the business. And it kind of, after a while, starts to just, sound like they're repeating the same thing. But I do honestly believe that having a good management team in place with the right incentive structure and with the right experience to actually go and execute on the strategy is incredibly important. And we've seen it time and time again. Like if we've had an investment thesis, it sounds incredible, but then the management team hasn't been correctly incentivized, that their short-term and long-term incentives aren't closely aligned to shareholders. Maybe they don't have, a significant ownership stake in the company. And we just see that, time and time again, they fail to execute on the strategy and the investment thesis often falls apart as a result. So I think one of the biggest lessons for me and some advice I'd give people looking to invest is to do your due diligence on management, not necessarily just the CEO and the CFO. I'd even go the level below and look at, the head of sales, the chief marketing officer, the chief technology officer. Do your due diligence because at the end of the day, you're investing in a management team to go away and execute on the company's strategy.
Yeah, it's interesting you say management team because I think that's one of the things that Mads and I always tend to look at, and you look at the people's story because it's not easy to relate to, but it kind of gives you flavour to how they're managing the business. But what would you specifically look for in people that are, if you're going down to that level of middle management, like what are you looking for? Are you looking for that they have a good career, a good background, like?
Yeah, I'd definitely be looking at whether they've got experience that's relevant to the industry. What's their track record been like? I mean, ideally we get great access to the CEO and the CFO, but we often try and get access to that next layer down of management, because often the CEO and the CFO are the talking heads, but the people, the women and men in the layer below, are the ones actually going out and executing. So it's great to meet with them and just actually hear if they're able to speak like quite specifically about how they're going to go and execute on something, you know, give you time horizons, give you clear metrics on, you know, what they're looking to achieve, what are their KPIs. That's a really good sign. I find if they're kind of waffling and not giving you specifics, that might be an indication that they don't really have a plan themselves. I definitely look at an annual report and have a look at, you know, management's incentives. You know, they will have hurdles in terms of what they have to hit in order to get paid their bonuses and their long-term incentives. So that's very useful to look at. But yeah, I mean, you can even go on LinkedIn, kind of do a little bit of a background check on some of these people and sticky beak on, you know, what other people are saying about them. You know, have they got, you know, recommendations, good industry contacts. Yeah, I mean, I think doing your DD on management teams is really important.
So for now, we're joking the other day that we like to go on Glassdoor and see what people are saying about their employers. It gives you like quite an interesting inside perspective on leadership.
Yeah, absolutely. Yeah, that's a good one.
So I'm interested to hear, what perspective do you think that sort of millennials can bring, and I guess particularly millennial women, to the investing landscape? You know, what's the sort of Eleanor contribution to the team, do you think?
I think one of the nice things about millennials is we're kind of a fresh pair of eyes. I think often, you know, men and women who've been in the industry for decades, you know, they do get a little bit wedded to companies, and they can also be a bit jaded by, you know, past companies, you know, failing to meet their expectations and being really disappointing investments, and then they never want to look at that company again, basically. Whereas, you know, a millennial's willing to go everywhere, have a look, consider new business models. So I think that's kind of one of the nice things about millennials. Maybe we're not so jaded. In terms of millennial women, I mean, I think women, and this is a bit of a generalization, but there have been studies done that women tend to take a little bit more of a medium-term view when it comes to just generally setting strategies, but in particular with investing. Like, we're willing to be a little bit more patient, we'll be a little bit more willing to hold. Whereas we definitely see this in the investment team, you know, men are very, you know, short-term driven, you know, they like to see short-term earnings be, you know, a big catalyst come off, and they may be less patient. But I think it's not necessarily a bad thing, because, you know, if you get profits right in the short term, you will get upside. So I think it's quite a nice complementary thing that women do take that kind of more patient approach. Men are a little bit more catalyst driven, and then if you kind of mix those two components into an investment team, it kind of balances out quite nicely. So I think that's kind of what a millennial woman might bring to an investment team.
Well, that's what they say, right? When you're working at work, it's like they want to hire diverse people because everyone needs to bring their own, you know, stuff to the table. But I think it's a good summary, because I mean, for me, I have a lot of friends that are always like, you know, maybe investing isn't for me, but really, if you bring your own perspective and you bring your own experience, there's something in investing for everyone, I find.
Absolutely. And I mean, to uncover a good investment opportunity, you can't be thinking the same as everybody else, because if you're thinking the same as the way the market's thinking, it's probably already in the price. Like, to be different is where you really find that alpha in a stock. You've got to uncover a different angle. You can't be thinking the same as everybody else.
Well, speaking of discovering a new angle, can you give us a recent example of a stock that you pitched to add to the fund, and sort of what helped you build the conviction in that stock?
Yes, so kind of going back to what I was saying about, you know, one of Firetrail's key philosophies is about, you know, trying to focus on those 2 or 3 key things that matter. That's really helped us with one investment we've made fairly recently. It was the start of this year. It's one of the top holdings in the fund at the moment, and that was in aged care operator Estia. And I'm not sure if you've ever looked at any of the aged care operators or that space, but it's kind of a bit of a no man's land. Nobody wants to go there. There's a lot of regulation. The sector's been absolutely hammered over the last 5 years because government's basically cut funding, and it's meant you've had negative jaws because their costs have been inflating ahead of the indexation that the government's been providing. So people just have steered clear of the sector. It's complicated, regulations changing. And so we kind of took a step back and went, well, this is actually a key piece of infrastructure for Australia, the Australian population. We have an ageing population. The population over the age of 85, is set to grow at, 4 to 5% per annum versus the normal population at 1.5%. So we know that we need aged care operators. The government knows that operating margins in the sector are way too low. And so they need to change that. They need to improve funding in order to attract capital back into the sector so that, Australia has enough beds to support all these people that are going to be moving into that kind of 85 plus age bracket. So if you take a step back, even though it's quite unclear what's happening in terms of the regulation, we know where it needs to go. And the other really exciting thing about the aged care sector is that it was not a COVID beneficiary, unlike a lot of the other healthcare names. And so what we're starting to see is that occupancy in the sector recovery, and it's really leveraged. So every 1% increase in occupancy over 90% equates to about 5 million of EBITDA for Estia. So when we see that occupancy improve, we're going to see earnings improve, and then medium term, we're expecting this funding outlook to really improve. And so we just think it's a great place to be. 70% of the valuation of the company sits within its property assets. So you've kind of got a floor under the share price, and then the rest is all upside. So yeah, that's kind of how we've uncovered that opportunity, is just kind of taking a step back and saying, well, this is important infrastructure. This matters to Australians, and therefore we think we can build a pretty rock solid investment thesis around it.
So I feel like you have combined two lessons that I really took away from Finvest. And for anyone listening, we met Eleanor at Finvest, so just bring it back to where we first met. The first one is that you can find really good companies in industries that people don't like because they don't touch it. So it's like you can find something good, like a diamond in the rough. And the second is invest in something that has like an inflection point. So like if there's money being pumped into a sector, then you can often find good investment opportunities there. And I feel like that really combined two of the lessons that I took away.
Look at you go.
Awesome. Perfect.
Do you have any tips for sort of when you have an idea and you start to research it and you think that, you sort of build your conviction in it? What sort of helps you stand strong or stay strong in that conviction when maybe there are conflicting ideas going around, especially at the fund? And I guess what would you sort of suggest to someone who is wanting to like replicate that experience?
Unfortunately, I don't feel like there's an easy answer for this, except that you have to do the work, because if you don't do the work, you're just not going to build that conviction. So you've got to be willing to go deeper, read more, think outside the box in terms of your research, talk to, as many different contacts as you can to really try and build a holistic view of not only the company you're looking at, but the industry. Maybe think about that industry in different countries, look at the competitor set, talk to people who work in the industry. You've just, in order to build conviction, there's no easy way. You've got to go out and do the work. That's the only way, unfortunately. I wish I had an easier solution for you.
Not the answer we want. We are going to take a quick ad break for our sponsors, but we'll be right back to get to your bread and butter, which is small cap investing. Small cap is one of those classic investing jargon terms. Can you break it down for us? What is a small cap stock? And more importantly, why have they become your area of interest?
Okay, so when we talk about small caps, we're basically, if you think about the Australian share market, you've got kind of the top 100 companies, which would be the ASX 100. Small caps is basically anything below that. So yeah, you're probably going from, say $3 or $4 billion company, still considered a small cap. I know that sounds huge, but that would still be sitting in small cap land. And then we'd probably go all the way down to 100 mil market cap. And then below that, you're starting to get into micro cap territory. So we're kind of focused on that part of the market, and it's a pretty large universe. We've got about 700 different companies in the small cap universe. Our fund is benchmarked against the small ordinaries, which is basically goes from that X100 all the way down to the 300. So there's about 200 companies that sit in the small ords, but we can also invest below that. Huge universe. How I got into small caps, well, originally I was working on our large cap fund, but the sectors I were working on had a lot of companies that kind of sat more in that kind of SMID space, so small to mid cap. And so I just kind of naturally got drawn more into the small caps. I was looking at media, consumer tech, and then at Firetrail, we were running at our market neutral fund, and we had a small cap sleeve in the market neutral fund. And I was working on that part of the fund with another guy called Matt. And then just before COVID, we kind of stepped out of that focus area and launched the Firetrail Australian Small Companies Fund. And for me, I find investing in small caps incredibly exciting, because if you think about, the ASX 100, like they've done their dash in terms of growth, like they're the top 100 companies in Australia already. Whereas when it comes to, small caps, you're trying to find what's that next company that's going to get into the 100s. And that's where you get the really big returns instead of, CBA is having a good year if it's up 20%, whereas, small caps having a good year if it's up 100%. There's just a lot more alpha on offer in small caps. But that being said, there's also heightened levels of risk because the business models aren't as proven out. They're not as... they don't have such long-term track records or such, strong corporate governance. So you are part of the job with investing in small caps is trying to avoid the bombs. So whilst you're trying to find these incredible companies that can grow into the next big Australian companies, you've also got to make sure that you're really managing risk and doing a lot of due diligence. So it's lots of fun.
So the natural follow-up question that comes to mind is, how do you avoid the bombs? When you're looking at a company, are there any sort of things that stand out to you as like key risks that make you think, I don't want to go there? Or I guess vice versa, anything that when you see it, it's like, that's something that's particularly interesting that you might dig further?
Yeah, well, as I said, we're looking at a huge universe, so 700 different companies. So one part of our process is to actually put a company through what we call an investment quality scorecard. And that just allows us to quickly filter out an idea and figure out, actually, do you know what, that's got too many hairs on it, it's got some red flags, let's park that idea and move on to something else. So we'll probably spend about a day going through this investment grade scorecard. And what we're looking at, so there's kind of three components to the scorecard. So the first is kind of back to the previous point we made around management teams. We'll do due diligence on the management team, we'll do due diligence on the board, make sure that, they're strongly aligned in terms of their incentives with shareholders. We'll make sure they've got the right level of experience that's suitable for the industry and the company. Another thing we'll look at is financial disclosure. So often with small caps, what you'll see is that they might change around how they disclose things within their segmentals, or they might change kind of some of their key metrics that they're reporting. And that's a little bit of a red flag. If we're having trouble forecasting the earnings for that company, we would put that in the too hard basket. If I can't forecast with certainty based off your historicals, what you're going to do in the future, we'll filter that out. We kind of need some regular reporting from that company. The third thing we'll look at is, is the business model sustainable? So if you think about, the buy now, pay later space, there are a lot of kind of subscale players that popped up. And we pretty quickly came to the conclusion that it was going to be quite hard for them to get scale and to be around in 3 to 5 years' time. So that was a quick and easy, filter out of, our investment universe. We just didn't look at them. And so that's kind of, I guess how one way in which we avoid the bombs is just putting them through that quick kind of process to filter out if they're a good investment opportunity or not.
Maddie can probably mention her buy now, pay later investment that she made, which has been a bit of a disaster.
Pass.
Pass on. We don't want to talk about those, just under the rug.
No, we speak openly about our mistakes here because mistakes are all about learning.
Yes.
That's very true.
So you've previously mentioned in a couple of interviews that I've read that Firetrail doesn't really invest based on like themes or thematics, but instead you kind of turn to the philosophy that every company has a price, meaning, there's a certain price you'd pay for the company, otherwise you'd say it's too expensive. How do you determine what actually is a good price for a company? And this is a question we get asked a lot by the community because it can be really confusing to look at a single price and think, is that expensive or cheap?
Yes, yeah. So it does depend a little bit on the sector, the valuation methodology we'd use. I mean, our kind of base valuation for kind of any typical industrial consumer company, any company basically with earnings, is we'd look at multiples. So we're going to look at the key number one multiple we'd look at is price to earnings, so PE-REL. And when I say PE-REL, what that means is we're looking at the PE of that company relative to the PE of the market. So what we might see is, that a company, historically has traded at a 20% premium to the market. And for some reason, that company is now, say, trading in line with the market or, at a discount to the market. And that kind of throws up a potential investment opportunity. We need to uncover why is that company now trading at a discount? Has something fundamentally changed? Has its balance sheet deteriorated? And so we'll try and figure out whether that company has derated for a reason, or if not, it actually is potentially a really good upside opportunity because it should re-rate back to that, historical kind of premium or discount it's traded at versus the market. So that's kind of one key thing we'll look at. When it comes to kind of growth companies that don't have earnings because they're reinvesting in growing the business, we generally would look at a DCF. Like you actually do have to look at those kind of more, long duration kind of cash flows and discount them back, which is a little bit more work in terms of forecasting. And then we would cross-check that looking at, an EV to sales multiple versus, kind of other high-growth tech companies or high-growth companies. And we'd look at that relative to the growth, the top-line growth. So there's kind of a few different valuation methodologies we'd look at. You could look at price to book, if you're looking at a bank. So I guess it's not a one-size-fits-all solution, which is, why, you probably have to do, your CFA or a course just to know which valuation methodology is the best. But I mean, certainly just looking at the price of a company isn't going to tell you anything. You really need to look at the multiples, and you probably need to go and actually forecast the earnings to figure out what the right multiple is it's trading on. Because what we sometimes see, and we're seeing this at the moment because, we are heading into a macro downturn, and we are seeing that consensus, so, all the analysts on the sell side haven't necessarily moved their earnings number enough. So instead of factoring in a downturn, they might be assuming there's going to be a little bit of growth into next year. So all of a sudden, some of the PE multiples are actually looking really interesting for some of these companies. They're looking really, cheap, but actually the earnings is wrong. So if the earnings needs to come down by 20%, suddenly the PE blows out and it's not that cheap. So you really do have to do your work in terms of forecasting earnings to figure out, what those multiples are really telling you.
So, Eleanor, if you were to look into your crystal ball and have an insight into the future, what industries do you think will come out on top in the next couple of years? And can you give some examples of some of your favourite small cap investment opportunities in those industries?
Yeah, sure. So we've touched on aged care. I think that's a really interesting industry if we kind of take more of a medium-term view. I also think in the media sector, you've got a lot of kind of traditional media players that, probably are structurally challenged, but one that isn't would be oOh!media. So if you think about, TV losing share, because of Netflix and other subscription services similar to radio. And so if you want to do a big brand campaign, online's just not going to get the same traction. It's more performance-based. So kind of your only option really is outdoor media. And I'm sure you've seen, out on the streets, they've started to digitize a lot of these signs. So they're doing really cool things, like if you want to have an ad that's weather dependent. So I don't know, if you want to advertise, an umbrella when it's raining. That's a really basic example, but, they're doing really clever things to adapt that industry to become more digital and based off, kind of demand. So, for example, in the morning, advertising coffee makes a lot more sense than, advertising dinner. So kind of adapting to that. So we think outdoor looks really interesting, kind of more medium term. It's currently about 7% of the ad market, and the industry's view is that they should get to 10%. So you've got some short-term volatility depending on what media ad markets are doing, but medium term we do think that's a structural grower. I'm trying to think what else. There's a lot of interesting opportunities in the technology space, which has been heavily sold off recently. We really like Life 360. I'm sure you guys, we pitched it at our FinFest. It is quite a new business model. And we think that's got huge potential, in the US market, looking at, that family safety. How can you use technology to better protect your family? So they're kind of, I guess, three ideas which we think, if you look out medium term, they're going to be winners.
Well, you said before, when you're looking at a company, you need to have a really holistic view and speak to people about the company and whatever else. And I will say, Maddie and I went up to the conference for O Media and did a little investing, how to invest. So can say all the employees are very money savvy now, and they're a great team. They're a really great team. So there's your insider pitch for O Media.
Fantastic. Oh, that's good to hear that you've met with the O Media team and done the due diligence for me.
Yeah, we've done our due diligence on the staff.
And female-led. Kathy came to our presentation. So
yeah, we love Kathy. She's awesome.
Well, we are almost getting to the end of today's chat, Eleanor, but before we get to our final question, if people want to learn more about you or about Firetrail, can you give us the pitch? Where should they head?
Okay, so if you want to learn more about Firetrail, we've actually got a fantastic website, which our head of sales, Kyle McIntyre, is very proud of. So if you type in www.firetrail.com, you should get all the info up there. And if you want to learn more about the funds, I can just give you a quick high level. So we've got 4 funds at Firetrail. So we've got the Australian High Conviction Fund, which is our large cap fund. There's about 25 stocks in that fund, and they all sit within the ASX 200. We've then got the Australian Small Companies Fund, which is the fund I work on, which is the most exciting fund because it's got the most alpha sitting there, so much alpha potential. So we've got about 40 stocks in the fund at the moment. And as I mentioned, we're benchmarked against the Small Ordinaries. A really great thing about our fund is that, so our index actually has about 35% of it sits within resources. So mining companies, energy stocks, and my co-portfolio manager, Matthew Fiss, he's actually got a resource background. He used to work for BHP for many years. He's a mining engineer, so we've really got an edge when it comes to that resource part of the market. Another fund we have is the market neutral fund. So basically that just takes out exposure to the market. So it basically takes $1 of your money and it goes $1.50 long and $1.50 short, and it takes out that market exposure. And that really pulls on kind of our best ideas from our large cap fund, our best ideas from our small cap fund, and then we have short ideas in there as well. And the final fund, which we've launched about 12 months ago now, is the Global Fund. So it's actually got a bit of a sustainability bent. So that fund is actually looking to uncover companies that are trying to improve their ESG credentials, because we see companies, like Tesla or companies with that real ESG lens, trade at huge premiums to other companies. So we're trying to kind of capture these companies before they become these ESG leaders. So that's a really great fund if you're looking to get more of a global exposure and you'd like a little bit of that kind of sustainability tilt in there as well. So they're the 4 Firetrail funds.
All sounds very interesting. I'm excited to check out the fabulous website. I'll give you some feedback. if there's anything.
That would be great.
Now, Eleanor, our final question, we touched on lessons before earlier in the episode, but we ask each guest the same question to finish out, which is, if you had a piece of advice for someone starting out on their investment journey, what would that piece of advice be?
I'd say when it comes to investing, you really need to do your research. Like, there's just no way around it. And I hear a lot of my friends kind of just following the pack, and they'll get a stock tip from someone and they'll just go, great, I'll just chuck some money in that, instead of actually trying to understand what that company does. Is it a good sector to invest in? Why? I just feel like there's no way around it. You need to do your research. And if you don't have the time to do the research, like, I'd recommend, maybe starting out putting your money to work with a fund manager or even in the index, because the great thing about that is it's less, you're not punting, you're actually getting a diversified portfolio that, through different market cycles should give you some, upside potential as well as some downside protection. Instead of, what we saw recently, in that sell-off where a lot of millennials put their money to work and they were all in the tech sector or high growth companies, which went so well up until it didn't. Whereas if you're investing, with a fund manager or in an index, you're getting that diversification. So you'd have some resource stocks in there, you'd have some banks in there. So your portfolio should withstand this market volatility a lot better.
It's a great piece of advice. Eleanor, thank you very much for joining us today.
No worries. Thanks for having me on the show, Maddie and Sophie. It's been great.